Chairman. Thanks a lot for the organizers for inviting me to this event today. It's a big honor for me to be here on behalf of the World Bank, and thanks to all of you for being part of this presentation. So today's presentation will be about empowering Indonesia's outside landscape. Let me start from what are going to be the three key takeaways I would like to get to out of this session. Our starting question is why financial innovation matters. And the first point is because financial innovation has the potential to expand the sources of funding through fintech and digital finance for both individuals and MSMEs. Okay, that's not better for me to see this now. Second takeaway is about improving financial stability through the adoption of super applications and financial supervisors. And third is about deepening the financial sector. So now let's be clear, each of these topics would deserve like one-day conversation itself. But I don't think the organizers will allow me to stay here so long. So in the next 20 minutes, what I would try to do is to develop a story, I hope a compelling one, around these three key takeaways and see the role of digital finance in each of them. And let me start by giving an overview of the Indonesian financial sector. Because if you look at it on the surface, the sector is doing pretty well. It has data confirmed that it has high asset quality, solid capital, bank levels, adequate bank profitability has been slightly decreasing during COVID, but still starting from a very high level. So overall, it's a solid sector, and we must recognize that the Indonesian financial sector authorities have definitely done a great job during COVID, intervening proactively to shield the sector from the impact of the pandemic. But if we start scratching that surface, then we see that the financial sector is not yet able to fund the development needs of Indonesia. And this is primarily for three structural weaknesses. The first is the size. So the sector is too small. If you look at financial sector assets over GDP, you see how Indonesia compares to other countries in Asia. And the same is about account ownership, where still almost half of the population is financially excluded. Second point is about the cost. So bank intermediation efficiency is still relatively low. And if you look at net interest margins, which is a typical measure of bank intermediation efficiency, you see that Indonesia has structurally higher net interest margins compared to peers. These high interest spreads are going to negatively impact domestic savings and illicit bank lending. And in fact, if we look at the private sector credit over GDP, which is a measure of deepening of the sector, you see how Indonesia compares to other key countries in the world. The third weakness is exposure to global risks. The institutional investor base is still extremely narrow in Indonesia. And this is especially relevant in terms of lack of longer-term finance. This implies a reliance on external funding, foreign funding. And when you depend on foreign funding, you are exposed to the volatility of financial markets, which is even more important these days in the uncertain environment that we're facing. So, why have I showed you these three weaknesses? Because we believe that digital finance can have an impact on those. And I'm sure those of you who are here today do not need to be convinced about the importance of digital finance. But finance is undergoing a profound transformation. Digital technologies are reshaping payments, lending, insurance, and the process that the COVID-19 pandemic is accelerating. So if there was a silver lining of COVID, it has been the acceleration of digital technologies adoption. Digital finance has the potential to bring about a positive economic change. You see here a study done by the McKinsey Global Institute, estimating that 6% of GDP of emerging economies can be boosted through digital economies, creating 95 million new jobs. So all this to say that digital finance can therefore have an impact also on the three weaknesses of the Indonesian financial sector. To understand how this impact plays out, we can use very quick and small conceptual framework. So starting from the idea that given the scarcity of resources vis-a-vis the development needs of Indonesia, there are 4 key steps that can be taken. The first is expanding the funding sources, so increasing the size of the sector. By doing so, this provides adequate resources for the expansion of lending and the increased usage of financial services. All this is going to support the smooth functioning of the financial sector. Now, this is important, but it's not sufficient. You still need the resources of the financial sector to be allocated efficiently within the sector to enhance the impact. And all this cannot be possible without having an enabling factor of financial stability and an enabling financial sector architecture. These 4 points together, these 4 steps, brings economic recovery and growth. So let me just go briefly into each one of these and provide an example of how digital finance can play a role in each of them. Starting from the expansion of funding sources. So digital technologies have enabled increased access to basic savings accounts, credit, insurance products. We know that they can lower costs, increase the speed, improve the transparency. And one clear example of this is digital credit that has already begun to make substantial inroads in expanding access to financing in Indonesia. Here is one example of what the World Bank did recently in supporting a partnership between fintech and banks. So we work with the largest peer-to-peer lender in Indonesia, Marta, and partnered with 3 different types and size of banks. The idea was to have the banks channeling funds from Marta in the amount of 1.2 trillion rupiah. And Marta would utilize the alternative credit data scoring technology and digital platform to help banks reach a segment of women entrepreneurs that they were not able to reach before. And the results of the pilot show, first of all, that new segments have been reached, so new borrowers have been acquired by banks. There is a good loan performance. So when we look at banks' loan performance, this is similar to the overall non-fintech portfolio. And the pilot is replicable across different types of banks. Now, the second step is about expanding lending and increasing use of financial services. So here we have to distinguish between services for individuals and services for micro, small, and medium enterprises. For individuals, a lot of good work has already been done in terms of banking saving accounts, agent networks. These are all widespread across the country. But still, large volume and recurrent payment streams like G2P or utility payments can be further digitalized. And when it comes to firms, you've seen how digital players can already provide a vast range of solutions, such as cloud accounting services, electronic platforms for B2B trades and communication. So let me just zoom on the G2P example. Here as well is another example of what the World Bank is doing in supporting the government. So Indonesia has made significant inroads already in establishing the necessary payments infrastructure to facilitate digitization of payment system. And at the same time, it has been undertaking reforms to improve the current G2P schemes. So as World Bank, we are assisting the government in adopting a more user-centric design in G2P payments. What does it mean? That social assistance, and you see here the example of PKH and Sembako, can be distributed by utilizing shared infrastructure for every program. At the same time, these programs will utilize the payment system interoperability that supports the very G2P program management. And that's going to be a combination of various payments instruments for various programs like e-money and debit cards to allow the beneficiary to choose which instruments to use in order to access the social benefits. When it comes to the efficient allocation of resources, we know that fintech and digital finance can be helpful in fostering finance at scale and provide greater risk diversification. They can help channeling savings into the most productive and investment opportunities in a less costly, faster, and more transparent way. And more importantly, I would say they can enhance competition in the financial sector. How? By constraining the market power of individual institutions and improving the efficiency of risk pricing while encouraging innovation. As of today, what we observe is that there is no much differentiation of risk pricing across Indonesia. So let me give you an example of why banking competition is important. So Banking system, as you know, in Indonesia is dominated by a few players that have considerable market power. State-owned banks play a very important role in servicing government business and micro, small, and medium enterprises. By doing so, they play an extremely important role in supporting the financial inclusion objectives of Indonesia. So that's great. But at the same time, there's this signals of universal pricing policy across Indonesia. So loans, interest rates are the same across different regions and independently of the creditworthiness of the borrower. So what can be done in this? And what can digital finance in particular help? Well, digital finance can encourage competition in delivering government-related banking services, support the entry of new financial and service providers, and encourage competition for micro, small, and medium enterprises. And at the same time, digital infrastructure as well play a key role, particularly when it comes to the role of credit information systems. Finally, financial stability. This is an enabling factor, right? So without stability, we cannot discuss anything else in terms of expanding funding sources and lending more. But there is a challenge when we have innovation associated to financial stability. It's a challenge on the regulatory side and on the supervisory side. On the regulatory side, it means that when there are new entrants that fall outside of the regulatory perimeter, it means it's difficult to assess risks, to include those of financial stability, and requires new policies to enable these new players and financial innovation to be supporting the stability of the overall sector. And on the supervisory side, the expansion of the regulatory perimeter, on one hand, will stretch the supervisory capacity because there are going to be new products and markets that require supervision. And it also requires financial supervisors to adjust their supervisory framework and their modus operandi. So this requires an appropriate balance that needs to be found on one hand between preserving the safety and soundness of the system and allowing financial institutions and markets to perform their intended function. So an example here is the OJK Master Plan on the Indonesian financial sector for 2021-2025 that has a specific focus on the adoption of new supervisory technologies to facilitate and enhance the supervisory process. That's a clear focus that as World Bank we are supporting, working closely with OJK to achieve, and our experience in other countries show the importance of doing that because it improves the efficiency, reducing manual process, and making effective use of big data. So, why financial deepening mechanisms? Right? So we discussed the role that digital finance can play in deepening the financial sector. Well, it matters because it allows greater financial access and more resources are available to households and firms. It increases financial efficiency, more competition in the sector lowers the cost of intermediation. And it also contributes to increased financial resilience by giving access to instruments that can help recovery from adverse shock. And the shocks can be a job loss, as well as a natural disaster. So, as World Bank, what we presented last June during the launch of our flagship Indonesian Economic Prospects was a three-pillar strategy for deepening the financial sector in Indonesia. Let me run you quickly through the strategy in the remaining 5 minutes, highlighting those key areas of reform where digital finance can play a role. And this is part of the policy dialogue we're currently having with the government. So the first area is about increasing access and usage of financial services. What does it mean in practice? So it means primarily 3 things. One is establishing government data platform. As of today, as many of you know, financial service providers, when they have to conduct their customer due diligence, they have to access several records in different registries. Well, if you have a joint and common data platform, that's going to make the process much easier. And the same is speaking in digital IT. Indonesia is one of the few countries in Asia that still doesn't have that possibility. Establishing a fully interoperable data system. A lot has been done already by BI, with BI Fast, the API Indonesian standards, but more can be done, particularly when it comes to developing great infrastructure and use alternative data. And finally, promoting open banking services. So here is the role of allowing fintechs and third parties to have access directly to the account information of the customers. Other areas of reform that I will not discuss, but risk broadening and improving the quality of financial markets, so new market products as well as the market for risk hedging to attract international investors, and mobilizing long-term savings by expanding the coverage and also increasing the long-term investment of pension funds assets. The second pillar is about improving the allocation of resources. So again, the efficiency argument. And here as well, digital finance plays a key role, as we have seen, in promoting competition in the banking sector. So strengthening the capacity of lenders to adopt risk-based pricing, so shifting away from the current practices, opening the services of government business to the most capable provider, irrespective of the ownership type, so public and private ones, and expanding public equity guarantees for MSMEs, so supporting effective valuation policies from the core program. Other fundamental areas are about strengthening the insolvency framework, so promoting out-of-court forecasts and amending the bankruptcy law. Even more important now that we are in the final stage of the COVID impact, where many businesses are requiring a strong insolvency framework. And then protecting consumers. Again, critical with the increase of digital finance, improving the market cover supervision from BI and OJK, but the personal data protection law has just been an issue. And finally, the third pillar is about strengthening the effectiveness of financial sector oversight. As we've seen, a key part of stability where SUSTEC play a fundamental role, and will take even more going forward. As well as strengthening council preparedness and resolution framework, and promoting climate and natural disaster risk management, an area which is emerging, but as you can imagine, will become more and more prominent in the coming years. And here as well, the technology can play a fundamental role in helping Indonesia, who is extremely exposed to natural disasters, in promoting risk, adequate risk. So to conclude, let me go back to the key takeaways. I hope, so this was a high-level overview of policy areas where digital finance play a role. So digital finance is not only fundamental to provide more affordable and more accessible services for everyone, but as you have seen, it can help addressing the key structural weaknesses of the financial sector in Indonesia. So expanding the sources of funding through fintech and digital finance. It can improve financial stability through the adoption of SUSTEC, and it can further deepen the financial sector. With this, I'll stop here. Thank you very much for your attention.
Ladies and gents, once again, can you please give a big round of applause for our first speaker, Mr. Francesco